All right, I wanted to do a quick part two video for the first video I did on multiples with Visa and earnings and a pricey earnings multiple. We're gonna hop right into it. I like to keep the videos nice and short, so let's look at AMD today. Something I didn't mention in the first video is that you can use a different metric for each company, and some companies are better to value using other metrics than earnings. A lot of the high-flying tech companies, I believe, you should not use earnings. I know a lot of the market does, but there's a lot of hidden pieces of their cash flow. If you're only looking at earnings, a lot of these companies are spending a lot of money. Um, so I personally use operating cash flow. That's actually the metric I look at the most for most companies I'm evaluating. But let's get into it quick here. So everybody knows AMD chips. Just quickly looking at Stock Unlock just to kind of show everybody, on a landing page, you can get right to the company website if you need to. It tells you how many employees there are. It tells you, you know, which market it's in, which exchange, similar companies. So you can see that AMD has kind of risen a lot. Um, Had an amazing rebound this year. Um, well, let's get into the multiple and about paying multiples. Last video we talked about contraction and expansion, so we're going to keep that in mind as well. So we know we want to use operating cash flow. On Stock Unlock, you can go all the way back to the beginning of time for this company and look at its average multiples 49. Um, we might want to fast forward a bit into the future because it's a much different company now. The average is still extremely high. Um, but this just gives us a little bit of perspective when we're thinking about what multiple we want to assign the company. And, looking at a price to operating cash flow of 40, no matter which way you cut it, it is historically pretty low, which means that AMD's fundamentals have been rapidly improving. Um, and the market's not really paying up for it. We can look at some analysts, see that there's a high, average, and low range. We're not going to use this EPS. We're going to be looking at the operating cash flows, and there's a couple things you can do. You can either look at these revenues and extrapolate it based off of that. I normally would use an AI. I like Gemini for this. I don't have to worry about setting up a compounding calculator. I can literally just have it do it for me. So something I did really simple just to look is I compounded the revenues just to see how much the revenue growth would be in 5 years based on the analyst revenue numbers, and it's over 300% revenue growth. It tells you the formulas and everything. And then I also looked at the operating cash flows, and I did like a really bearish extrapolation of that numbers um, with just only a 20% growth over 5 years compounding with a 40 multiple. And I got about a little less than double the market cap, and then you divide that, and it would be a 75% gain. But today, what we're going to do is we're going to use a calculator. And the reason I like the Stock Unlock calculator is I can click on any metric I want, and I can see it's going to tell me historically what's going on. So it tells me historically over the last 5 years how much the operating cash flow has grown, which is 43%. Tells me how much dilution there is. Tells me what the average price multiple is, and then I can change the discount rate based on how risky the stock is. I chose 8% for this company. And what I did was I priced in what the market is pricing in for growth based on the stock price today. So today, the stock price is about $223. The market's pricing in only a 21% operating cash flow growth, a 4% dilution of shares, and a multiple of 39.45, which I think is very bearish. It would only be growing 8% per year. That's lower than the little thing I did with Gemini earlier. So let's look at what happens when we expand this. And again, you probably wouldn't want to pay a 40 ratio for a 21% growth. Let's look at 30. So just having the growth rate to the operating cash flow go to 30% per year, we're getting over a double in 5 years. And for those who don't know, a double, you need 15% per year compounded annual growth rate, which is what I'm shooting for everything. And there it is, right? Now, let's get a little bit more bullish. I still think the multiple is probably going to be lower, though. We get a multiple compression over the next 5 years, and they do end up growing 40%, which is all along in line with their averages. There is an argument that AMD continues to accelerate. My argument for the investment has been that they have chosen to focus on memory with their strategy, and they're able to save customers money through their having more memory for their products, as opposed to just beating the benchmarks and everything like NVIDIA. And also, I believe that the market, Mag7 and friends, do not want to only be buying from NVIDIA. They're eager to diversify the company that supplies them with these necessary items. So back to the point of this video, the point here is there is a margin of safety already built into the analysis. If the market really only thinks this is going to be the case, then AMD will underperform. But if it's even just slightly beating it, let's do 32. So 32% growth rate with a 35 multiple, which I think is fair for a 32% growth rate, is still a double. But you can see that it's really important what multiple you pay. If you're going to assume that it's going to be this average number, you're assuming some wild price targets, which are pretty unreasonable. So yeah, I hope this is helpful. If you haven't watched that first video, just check that out. That focuses more on earnings. But I personally believe that even if you were to look into AMD's earnings, it would still end up telling you that you're going to get a pretty high return on your money. Because the earnings would probably grow some obscene growth rate because they're not maximizing for or optimizing for earnings right now. They can easily squeeze out a 50%. And we don't really have to figure that out ourselves. We could just go to the analysts section and just see. We could do exactly what we did with Visa, and we could take the average. It's about a 25, and then just give it a 30 multiple. 750. Yeah. massive upside. But then, what if they actually hit that higher range, and the market's willing to pay up on the multiple? Still talking, you're getting close to $1,000. Um, in summary, I just want people to know that the going in multiple that you're paying for a company is very, 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 very important. It's probably the most important thing you're doing when you're about to purchase a stock. Overpaying can be a major factor into your performance over the years. And you always want to add some level of margin of safety to your plan. So if you're buying down here, you're adding a margin of safety because the average is so high. Even if you take the entire history of the company, you're paying below what their average price to operating cash flow is. So just through that, you're adding a margin of safety. Um, Happy to do more series if these are helpful. Thank you.